now.
Good afternoon, everybody. This is Christian Thwaites of Brad Janikowski. Welcome to our monthly market update webinar. I hope everyone can see the screen in front of me. Beautiful picture of Marin, and I'm on the website on one side, and Carolyn O'Neill's on the other. And we'll open it up to questions. And I think questions can be accessed through the web. So if you see a space for questions, just feel free to fire them up, and we'll answer them as we go along or at the end. Quite a lot has happened in the last month since we last talked. I think the biggest topic of the day is the inflation debate, which is essentially a tussle between the group that feels that the economy is on the mend, that there are some inflation indicators out there, that now we've had a big stimulus, which is likely to push some of those inflation boundaries a little further. And another group which has been used to a decade and a half, or actually more, of inflation never really reaching the Fed's target of 2%, an economy which has been operating under its capacity and therefore has quite a lot of headroom to expand without triggering inflation. Like a lot of these things, there's a lot of nuances to it. I don't want to sort of come out strongly on one side or the other. I do think the inflation concern is a little bit overdone at the moment, but it's real. It's not to be dismissed. And of course, the market is debating this as we speak. It's going to come up in both the fixed income markets and increasing the equity markets. Anyway, that's really the big topic of the day, and that's an improvement, because for much of the last 15 months, of course, we've been talking about this absolute brick wall the economy ran into over a year ago, where it essentially came to a full and immediate stop when we saw the biggest decline in output and most sudden decline in output we've ever seen, certainly as in 70, 80, 90 years. The financial crisis, which was very broad, also very deep, happened a little bit more slowly. I would say that the damage done to the economy by the COVID lockdown, it doesn't compare to the damage done to the economy in the GFC. And it's taken, it took many years for employment to come back to the level that it was pre-GFC, post-GFC, something like 7 or 8 years. And I think the output side never really got there in terms of regaining its momentum and on the trajectory it was before. There's a long fix for a very difficult problem. The COVID bounce back will be quick. And that's kind of our first point here, is that this lockdown has been incredibly hard on a lot of people, and people particularly in the consumer client facing parts of the economy have been hit hardest in terms of job losses, lower wages, and dependency on unemployment benefits. But those parts of the economy should come back relatively quickly. And again, unlike almost every other traditional recession, there hasn't been a destruction of capital in the form of excess borrowing, excess building, investment. So none of these things need to work their way out of the economy. It's something where, as we mentioned before, demand was shut off like a valve. It'll come back relatively quickly, and the snapback, I think, will be relatively quickly, and we'll just see more of it as we go into Q2. The stimulus, which is bounced between the House and the Senate, is now back with the House, should be signed within the next 48 hours, is unusual in that it nearly all just puts extra cash and spending power into people's pockets. So there's the $1,400 family credit, which tails off. So it's really going to the most needy. And that's very unlike the tax cuts from 2019, which benefited the top 5% of wage earners. This really does benefit the bulk of the wage earners who've been hurt most of it. So I think it's very well targeted. The other thing that's I think interesting about this one is that it puts in a child benefit allowance, which is actually quite generous. It's about $300 up to per child up to a certain age, and then there's about $3,600 that per child that could come into people's income, and that's not dependent on having a job, which is good news in my view. It sort of puts a little bit more spending power into households that need it most. There are other parts of it which extend the unemployment benefits, which is good. And there is a very positive multiplier effect between unemployment benefits and the broader economy. So keeping as many people spending as possible is a good thing. The other thing that I think this does is that a lot of this cash will be saved. So that's one of the points I'll make further on down the road. Some of it will go towards, forbearances of rent and other closure of, real estate that were forbeared up until this type of point. So a lot of it's going to be a transfer of money from the government to an individual to then, expenses that were suspended essentially for 6 months or 9 months. That's not inflationary. That's just moving it from one pocket to another. But there's a huge pent-up demand for services. We hear lots of anecdotal evidence about trips being booked for July, August. I'm sure all of the traditional tourist destinations are going to be pretty busy. Again, assuming the lockdown sort of is relaxed sort of at the same rate that that we think it is. Some services don't come back. You don't go out and go to 5 haircuts to make up for the 5 you missed, or suddenly go out to a restaurant 5 times a night just suddenly to make up for all those you've missed. But a lot of them will be where people will feel that they can spend again. And again, there's a huge amount of savings to go into those industries. You've got 60 million people vaccinated. I think the number of vaccinations is about 70, but a lot of them have the 2-shot ones. So the number vaccinated is still a little bit low. We have one of the highest, I think the highest vaccination rate in absolute terms in the world for sure. But per capita, it's pretty strong by now. So that seems to be happening. I'll show, your experiences at the local level may differ, but at the national level, these vaccines are getting to where they're needed. Again, since we've last spoken in early March, the bond market has continued to sell off, not drastically. The rates have slowly crept up from about 1% to 1.5%. That's it has not been a disorderly market, which I think is what the Fed would be worried about. 2 of the Fed governors, Jay Powell, of course, the chairman, and Lael Brainard, who's very smart about these things, and a couple of others, have said that they see this, they've taken note of it, and essentially what they're saying is this isn't disorderly, this isn't a liquidity crisis, so they don't see any need to up the bond buying or do more sort of verbal intervention and forward guidance. And for them, I think it's just for right now it's still pedal to the metal of low rates. We're not anticipating a Fed funds increase until 2022. They might announce some tapering at the end of 2021, depending on how the economy is going. That means they'll be buying less treasuries and mortgage backs than they are now. But I don't think they're about to make the monetary conditions much tighter. So there's some inflation risk for sure. We're going to see it in the short term, just because we're, for the simple reason I've mentioned this in the blog a few times, you've had things like oil and energy and some metal stocks bounce back from where they were a year ago. We're kind of on the 12-month anniversary when one of the oil futures notoriously traded negative, and spot oil was about $10, $11, $12. Now it's 50, 60. So that passes through in gasoline prices, heating prices, diesel prices, aviation fuel doesn't really matter anymore. Because they're not using it, but all those kind of get passed through, and the base effect from low prices 12 months ago to slightly higher prices now will happen. We had almost negative inflation for 5 months last year, starting in March, ending in the end of the summer. So there will be some year-over-year inflation numbers. You'll see about it. Bloomberg will talk about it. A lot of talking heads will say, there we go, I told you inflation was coming back, but it's really not. It's just a bounce back from relatively low levels. You need a few months to see whether or not the underlying core inflation is moving up rapidly. Risk assets have been sideways now, and I've got to say, for one perspective, I'm quite pleased because things have gotten way ahead of themselves. We all know what the large tech stocks did last year. I mean, just to give you an example, before I came on, I was looking at the 2 largest stocks in the following sectors: tech, communication services, and consumer discretionaries. So those 6 stocks are Apple, Microsoft, Google, Facebook, Amazon, and Tesla, which wasn't even in the S&P 500 up until November. You throw the market caps of those together, you're at $8 trillion out of a market cap of 32. So whatever that is, a lot. It's about 9, 10, 15, 20% of the market, something like that, 6 companies. But you take the 6 biggest companies in the financial, industrial, and energy sectors. And so interesting enough, those are JP Morgan, Bank of America, Honeywell, Union Pacific, Exxon, and Chevron. And those add up to 1.5 trillion. So you got the 6, and they employ more people than the others by quite a bit. But that just gives you an example. The 6 biggest in the big sectors that have been running, nearly 8 trillion. The 6 biggest in the sectors that haven't been running, 1.5. So there's still a lot of catching up to do. And I think some of the tech stocks and some of those names I mentioned, ran way ahead of themselves. So we are kind of seeing a sideways drift for now. The important thing is we're seeing more market and sector rotation. That's good. It means that people aren't abandoning the market. They're just trying to find value in other places. And I think that, some excess needs to be taken out of the system. And I'll mention those by name later on. Okay, just to kind of take through what I'm sure you've been following in the news. This is borrowed from our friends at Pantheon Economics, but there it is. The blue line is really what I look at, which is coming way down. So this is the number of new firm cases per day. Interestingly, the COVID tracking project, CTP or whatever it's called, which came up last year, has stopped publishing numbers as of March 7th. And I don't think that they've run out of funding or anything else like that. I think they see that the worst is behind them. So now we get our case information from John Hopkins and the World Health and a few other places. They have to kind of be amalgamated. But you can see definitely the number of cases has come down a lot. Remember, we hit 250,000 a day. You can see up in the top number up here back in December. Things look pretty bleak. Remember, vaccination day was November the 11th, 2 days after the election. And then so since then, the number of cases, have come down due to that second or third lockdown. So that definitely seems to be, moving in the right direction. And this looks good too. The number of vaccinations, this was 1.2 million a month ago. We're now at nearly 18 million. And it was 9% of the population, and it was 16%. So we're certainly kind of moving ahead well on that. And I expect this number here was a little bit of, this was the Texas outage and the storm outage in the Northeast. So that's the dip there. And then it suddenly started to come back quite solidly in the last few weeks. So that seems to be, going well. Let's have a look too at where we were with the back in January. This was the dreaded third wave. This was the first one, second one in midsummer, then this third really terrible one sort of in November, December time. We were pulling away nicely from the rest of the world here in terms of this is a number of cases per 100,000. So this was kind of rapidly getting out of control. Now you look at these numbers and there's a big drop, and there's the United States. It's kind of fallen through the Italy and France and European level. As I said, we're at about, on a 7-day moving average, we seem to be around about 20 or 30 per 100,000. So that's the one to measure. In absolute numbers, it's about 40,000, but this is 20, 30 per 100,000 of the population. So it's definitely moving. Germany is kind of flatlining, and I think this still is hidden here behind the European Union and Italy. But you can see this kind of sideways. That's the winter storms, that's the Texas outage, and now it's begun to decline again. So that's all good news. It's all kind of moving in the right direction. I think I read somewhere we had the kind of worst take on of COVID and sort of worst case experience, but we got one of the better vaccination programs. And then, maybe it's a little tempting fate to say it's the final stretch, but California is down there at the bottom. Remember these big spikes? This was South Dakota. A month, a little bit roundabout here was the famous Sturgis rally, which infiltrated a lot of states in the upper Midwest, Wisconsin and the 2 Dakotas. I've taken them off right now because they're not that important anymore because their numbers are down and the populations aren't that big. But anyway, the big states here are obviously moving down. Yes, I know Texas has probably moved a little bit too early on the mask and shutdown stuff, but they do things differently there. This is really the story of the month, where, a month ago we met, and the yield curve, so this is just taking, yields from 6 months, almost zero, all the way out to 30 years, just under 2% a month ago. And this whole curve, ignore the blue one for a minute, this I think it's yellow, I'm a bit colorblind, could be green. But anyway, this lighter one at the top is all moved up. And the news has especially been in the 10-year number, which is about 1.2% and is now about 1.55%. So it's definitely moved up. That's been the big story. You'll notice that down here, under 2 to 3 years, it hasn't really moved much. While we've had a post-pandemic high of the 10-year Treasury at about 1.5%, the 2-year Treasuries continues to hover around record lows, about 11 basis points. And the reason for that is there's a lot of demand for short-term money, but most importantly, the Fed is holding things tight at the lower end of the market. They're buying a lot of this stuff, but more importantly, there's a limit to how far the 2-year Treasury can go when the Fed fund rate is locked in at zero. So this is what you'd expect in a kind of a healthy economy, all things being equal. A steeper yield curve is better. Not always, but that's kind of a decent rule of thumb that won't let you down too many times. And we've seen the yield curve steepen quite a bit in the last month. Now, again, this is a little bit of the economy is coming back. It's growthier. That's more positive versus inflation's coming back, and bond investors are demanding a yield premium in order to protect themselves against inflation. They're not mutually exclusive. So, obviously I lean more towards the growth side of it. And, if we didn't see any move in the 10-year in the yield curve at all, this kind of just stuck around here, would tell me that we hadn't got things right, that the economy still had capacity to grow and we weren't providing enough fuel and oxygen to help it grow. But that's been the big move in the 10-year rate. But before we get too concerned about that, I just point out, this is the United States one. I put the numbers in there. They're all mushed together at the bottom here, but as you can see, it takes almost 2 years before you get to 14 basis points. And here's the 10-year at 1.6 yesterday, I think it was, might have been today. Yes, March 9th. And then the 30-year at 2.29. So that is, all things being equal, a healthy yield curve. You're paying more to go further out in the yield. This, by contrast, the next one down, the United Kingdom, is a very unhealthy yield curve, because you've got some inversion going on there, and I suspect that's due to the scarcity of the 50-year bond. But then you look at these other guys, the Germany, Switzerland, and Japan yield curves. That's this one, and this one. And they're barely registering positive rates. I mean, with Switzerland, you never get a positive rate on your bond. Even if you go out to 30 years, you're still getting negative rates. With Germany, you have to get almost 20 years before you get a positive rate. My point about this is two things. One is that, Japan, Germany, and Switzerland, let's say Germany is a pretty good proxy for the EU. Not all EU borrowers can borrow as well as Germany, that's for sure. But but Germany's economic growth is inextricably intertwined with the EU. So you kind of got the big three economic blocks of Japan, which throws in a bit of Asia because of who it exports to. Germany and Switzerland representing the core of Europe, and those bond rates are considerably lower. Now, I think that's because their inflation outlook is more deflationary than not. That's not usually a good sign. And their growth outlook is quite a bit lower as well. So until we see these others move up, I think the United States yield curve, especially the 10-year Treasury, won't go to enormous rates, just because all these guys are natural buyers of US Treasuries. And the more they see this yield differential positive in favor of the US, the more they're likely to buy it and start bringing it down again. So, in a world of still low rates, the US is still quite a ways ahead, and I think that indicates the better growth prospects that we've got in the US over the next 12 months. I've thrown this chart up a few times. This is a result of, when the kind of perennial question comes up, when is the Fed likely to rise rates? And essentially, the Fed has been saying, every time they've been asked this for the last 3 months, is essentially a polite version of saying, Don't ask. They're looking at inflation, while inflation is recording, 1.5, 1.7% in a good month. They're not even going to talk about a timeline for this. And what they did last August, which I mentioned before, I think it's very important this because they did slightly change the emphasis on the Fed's dual mandate from being 2% inflation, low inflation, to full employment. And they've kept that full employment, but they've expanded it to other sectors of the economy. They talked about employment amongst lower paid, unemployment amongst minorities. So they've sort of broadened that almost into a kind of a social goal. And at the same time, they said they would allow inflation to run. Now, they didn't say by how much or for how long, but over the 2% target. So the days of, oh my gosh, we're coming towards 2%, the Fed's going to slam on the brakes, are over. That's at least that's what they're telling us. And then I think that's likely to be the case. So these are the only 4 times in the last 70 years where these goals of about unemployment at 4%, which they didn't mention by name, but seems to be the one which they're favoring as a definition of full employment, and the inflation at 2%, which they did name. So they put a number on one, but not on the other. The only times they've converged is these times. And look at that today. The last employment number from last Friday was 6.2%. The latest inflation number is 1.3. We get another print tomorrow. I don't think it's going to be much more than that. So it's a long ways before we see the Fed likely to act. Now, without sort of overemphasizing the case that inflation is a temporary worry, I will acknowledge that it's out there and it's not being imagined by the people who see it in a more pessimistic light than we do. But this is the one which the last couple of weeks got people a bit nervous. And this is the ISM's Institute of Supply Management. It's a survey, and they ask people in the manufacturing and the non-manufacturing, which is really just the services economy, how they see prices. So this could be for a manufacturer, it's the cost of their steel. It's the prices which they're paying, not the prices which they're asking for. And also, if you're in the services economy, you're a constructor and you've got to buy lumber, it's asking prices like, what are you seeing in those prices? Now, these numbers are pretty high. This doesn't mean they expect 86% inflation, it's just that 86% of people said they think prices are going to go up, and 71% here. And that's been high before. And in most of these cases, it's come down pretty quickly. And if I tracked an inflation number under here, there wouldn't necessarily be much correlation between what these guys are paying and what they're then feeding through in final demand prices. In other words, some of these prices they might absorb by higher productivity, or they might switch materials, or they might just have lower margins. So it's not a direct one-for-one, but I do point it out because it is quite a big jump from where we were, a year ago, where things were very deflationary, and now it's moving up. So again, this is what the group which deals that inflation is going to be a rather tricky problem would point to, and it's not without merit. The question is that does it pass through to the broader general economy? The other one is commodities. I've mentioned oil. Similar story in copper, nickel, aluminium. These type of base metal prices. Also, silver tends to be in there. We've kind of put a lot of this number here, 17.92, is a kind of a basket of different type of commodities. So it represents the metals as well as energy as well as food. So this is year over year, it's up 17%. Here we are with this core inflation at 1.4%. Yeah, sometimes that goes up. Like here's a good example. In 2008, saw a big spike. The commodity index was up 40%. That was all to do with copper right after the great crash and a big demand from China. Did it feed through to inflation? No, not really. I mean, inflation took a dive down and a small climb up. So again, you have to be careful to saying, well, just because we're seeing inflation in some of those input prices from the chart before and from the commodity side, will that lead to greater increases in our day-to-day price inflation? And the answer is a little mixed, as from this slide. So, but again, kind of weighing all these together, what have we got so far? We've got some input prices, we've got some commodity prices that are going up, Does it lead to broader, wider, deeper inflation? That remains to be seen. I look at this one as probably the most important indicator. It's really, are wages going up? This top one is the hourly wages, the 5.2%. So you look at that and you go, my God, it really kicked up. Great thing to happen. You're in work and your hourly wages went up 5%. But as I mentioned a couple of times before, this is really a sleight of hand statistical illusion because it's the hourly wages we get from the unemployment report, and the people who lost their jobs the most were in industries which paid much lower average hourly earnings. The average weekly earnings, remember, about $1,000 on average, and the people who lost their job in things like the travel and leisure sector earn about 350. So, a lot less. So take them out of the pool, and it looks like everyone else has had a pay rise. So this one is not worth looking at. And in fact, that's going to go negative in the next few months as more of those people come back into the workforce. These are the ones to look at, which is unfortunately come out quarterly. But this really shows that, what the employers are paying, both with benefits included and wages. And they're sort of, there they are, so 2.6%, lower than they were a decade ago, a little bit higher than they were 5 or 6 years ago. But, a move from 1.5 to 2.5 isn't really enough to start triggering a lot of inflation. But so if these start moving, then I'd be more concerned about inflation. And they're not the most timely of statistics, but I think, the fact that we have to wait for them is a good thing. Otherwise, we react on every single data point. But so far, this is showing that employment costs are low and are staying low. The small business sector, the NFIB, National Federation of Independent Businesses, very important. These companies that is an industry which represents companies with less than, I think, 200 employees. We remember that the US workforce, I think 40% of them are employed by companies of less than 50 people. So how these people feel, how this NFIB feels about the future, well, we kind of look at the latest data and says, what's your outlook for expansion in the next 3 months? And what's your outlook for compensation plans in the next 3 months? You've got very, very low numbers here. People back in the, Trump tax cut time, they was expecting a big expansion there. Then that number got up to about 35%. But now it's kind of way down and kind of similar to what it was, 7 years ago. I think if you saw an inflationary pressure, you'd see the NFIB, they're usually the first off the bat to talk about, well, we expect to have to pay people more in the next 3 or 4 months. So far, that's not signaling that at all. And the other one is the deficits. There's no doubt the deficits are going to get big. And I think I saw the CBO, the Congressional Budget Office, came out with something the other day, which is that the national debt will be 200% of GDP by 2030 or 40 or something like that. Good headline. It doesn't really concern myself or the bond rate or bond market, I think, more importantly, because the size of the deficit is somewhat important, but how much you pay on the interest on the deficit is much more important. And you can see that with current interest rates, back in '88, when people were really fussing about the twin deficits a lot, that was when you saw the national debt clock established and everything. We were paying 5% of GDP and $500 billion in interest payments alone. Now that number's way down here. So, the net interest payments on the national debt as a percent of GDP are very low. That's a function of having low interest rates. Until we really get an economy operating at fuller capacity, then we can kind of address the deficit issue. But for now, it's not really putting any pressure on bonds or interest rates or the ability for the government to fund other parts of its expenditure. But it's out there as a background, and I'm sure it'll continue to come up every now and then. But I don't think from a macroeconomic point of view, it's a particularly big issue right now. Now, we got to get on to the jobs market, because this is the thing that obviously got hit the worst in in spring of last year. That's where we had up here like 22 million job losses. Weekly claims skyrocketed from this 220,000 level to 6-7 million. The shorter answer is this, and I write about this every week, is until this clears up, until we're at the point where we can say we're back to a normalized level of weekly claims, and I think that's got to be at least below 300,000, then this is something worth tracking very, very closely. Now, the data isn't always fully up to date, and they revise quite a bit, but it's essentially the number of people who sign on for unemployment in a week. And they come out every Thursday morning, and they're a week old. And there's some messing around with double counting, and some states are more accurate than others, and some people sign on twice by mistake, and some people come in unemployed, go back to work, sign on again. But anyway, the numbers have gotten slightly better, and what we're looking for here is for this number to slowly, it's 745 last week, it'll start to edge down, but it'd be, I think we're looking for like 400,000 by May or June. This number's got to come down if we're going to have a more robust employment market. So that's still not there yet. And then in the payrolls, again, this is the 22 million, these big two negative numbers here. At the back end of last year, this was the second wave where we were at, you can't really see the numbers here because I've had to adjust the scale so much, but we had, you can see it in the bars. We had 3 months of pretty awful numbers, but they did recover last month, and there shouldn't be too much noise in that data. They might even be a little, the real numbers might be a little bit, higher again, given some seasonal adjustments and what went on with all of the storms. So this number should start climbing up over the next few months by quite a bit, like 400, 500,000. We might even get closer to 700,000-800,000 in a month or two. So this is something which is a cataclysmic drop, somewhat of a gain, a disappointing tail off of gains in the end of 2020 into early 21, and then slowly this should start climbing. The unemployment rate's down here at 6.2%, but ignore that for the minute because it's undercounting the number of people unemployed. The GDP numbers, I'll just flip to this one, which is the most useful one. So, we saw this big decline here, -5, -30, then up 33, and the fourth quarter came in at 4, and the expectations right now for the current quarter to be at 8. So we're definitely expecting things in Q1 2021 to be better than fourth quarter 2020 because more things are opening. We're dealing with it a lot better. So this is good for the year as a whole. Bit difficult to tell how quickly this will snap back, but I think we could be looking at a 8-10% number of GDP for the year as a whole. That'll sort of get us back to the starting point, which is good. But these GDP now estimates are a bit volatile because they kind of work them off data points that come out through the quarter. But eventually, by the end of the quarter, the Atlanta Fed's pretty much in line with what the real GDP numbers are. So we've only got 2 more weeks left of the current quarter, and they, unless they have a big revision down, which I don't think they will, we're looking at somewhere between 6 to 8% growth, and that's pretty much baked into prices right now. Consumers continue to save. I mean, a lot of the money that was sent in the first wave went into personal savings rate. This is, normal savings rate back here was about $1 trillion and that's just savings accounts normally, so it's one away from checking accounts, but it's fairly liquid assets. It's not tied up in illiquid securities and things like that. And that's obviously rocketed up to, it was as high as 6 trillion. Some of it's been spent down, but it's about 4 trillion now. It'll go up again as a result of the current stimulus, which will, I think the first check should be going out, hopefully within about 2 weeks. But you can see the savings rate. This is a normal savings rate, somewhere between about 5 to 6%. It shot up to 35%, and now it's back at 20. So this is important to remember that this number will go up because of the new stimulus check rounds coming out, and this all represents pent-up spending. People are not going to keep saving at a 20% savings rate. They just don't do that if they're feeling more confident about the world. And these big cash balances, they're going to be headed towards spending. I mean, not all of it, of course, but there's an awful lot of firepower out there. Housing and autos, same story, is done really well. This is housing starts. I usually look at housing starts, existing home sales and new home sales. They all tell pretty much the same story, which is that these have held up pretty well. The peak number was December. If you take this further back, this is still, we had housing starts of 2.2 million in 2004, 5, 6 prior to the crash. It doesn't need to be that high again. As many of you know, that was a very speculative bubble in housing, which took a long time to work its way out. This is a kind of a more normal rate, and it's been pretty strong. You know, it's stayed well. Demand for housing, for all the reasons we've talked about, the changes in habit from working from home, etc. There's still the housing demand is still pretty high, and the supply is still pretty low. This is the S&P. So you can see at the top there, we've had this little correction. We went from about 3,900 to whatever it is today, 30, this was a day ago, 3,800. This dividends and earnings number is on the dividends number is slightly better than when we met a month ago. In other words, companies came through with marginally, and we're only talking 40 cents on $59, but slightly better dividends per share than the prior month. And that, you know, after taking a tick down last year, is sort of edging up nicely. I expect that to sort of continue to rise. And then the earnings per share, obviously we saw the decline in that, but more important than that is what's the outlook, and a lot of the forecasted outlook and guidance that we saw from the S&P 500 companies was very positive. So that continues to be pretty good. These are the rolling year numbers, which I'll go over these. I'll skip over that one for now, but this is just to give you an idea how fast this bull market has come. So we just kind of took a look at some of the stats that said, what's the, I can't read my text. Yeah, what's the S&P 500 return over 11 months from its trough? In other words, when the market hits bottom, what does it do over the next 11 months? It just took 11 months because we're 11 months away from when it started to ramp up. Here's a big recovery back in 1932. This is just the second biggest one in that time. So a lot of the market has come on very quickly, and we saw that with the kind of, you know, the winner take all, the work from home stocks, which are, you know, giant stocks. So the point is that we made a lot of money very quickly. A sideways halt in the market, I think, is something greatly to be desired, just to kind of take some froth out of the thing. Unfortunately, markets don't always correct by going sideways, so we'll see some things come down, but we've made an awful lot of money in a short space of time. And I think we don't want to get into the world of 1999, where things just get crazily out of hand, or 2007, 2008. I don't think we're there across the market. There are some speculative bubbles. I should be able to chat about those in a minute. But just to remind us how fast we've come. So, you know, it's okay to have a sideways correction or rest, if you like. Just a reminder of what happens in 2020. It was the top 5 story. Top 5 stocks from January through September, up 43%, which is unbelievable how big those companies were. I think they were 30% of the index or something. And then the rest of the world was really not much of interest. Emerging markets, small and mid cap. Small cap lost a lot of money. Mid cap, emerging market was pretty much sideways, and mid cap was down about 10%. And boy, have things turned around. You know, small cap since December, the middle of December, is up 21%. Mid cap up 12%. Emerging market up 6%. And then, as you'd expect, the top 5 have taken a rest, so they're down 2.5%. But this is the kind of the healthy thing which I was talking about earlier. This is kind of rotation, not just within the market from one sector to another, one industry to another, or one kind of value sector, or from one growth sector to another value sector. This is across different size market caps, which I think is very healthy, because the more it spreads out, the more wider the benefits of the recovery are going to be. So small caps are very sensitive to broad economic growth, and the fact that they've come back so strongly is a good indication that people feel that this recovery is real and it's going to hit more than just the top guys. I'll leave that one for now. There has been some talk about value versus growth, and we've seen that since January. This is, I think, year to date. Now, I always have a bit of a problem with the value versus growth. I don't have a problem defining it and exactly what people mean by it, but I think its definitional changes have become a little warped over the last few years. But basically, if you're talking about value, you're talking about today, the energy world and the financial world. Financials tend to trade cheaply on a price to book value for good reasons. Don't need to go into those yet, but they also have relatively decent yields, and investors don't view them as growth stocks, so they tend not to have very challenging multiples. On the energy side, they tend to, again, have pretty low earnings multiples and big fat yields. So the Exxon, Chevrons I mentioned earlier on 4 or 5% yields. So those have come back into fashion. Here we are. Let's see. Value stocks are up about 8%. Growth stocks are down about 4%. So we've seen a big outperformance of value from growth, especially from around about the beginning of February. Now, longer term, it's a very different story. If you there are times when value does well back here in 06, but if you put $1 into value versus value or growth back in 91, you'd be, almost double the amount of money you made in value. But I think the point I take away from this is, yes, the market is expanding out a little bit. Markets are a little bit more recognizing that some sectors have been left behind. Growth stocks have been bid up so high that now people are looking around and saying, well, maybe with higher interest rates, which is important for financials, or the broader economy getting more uplift from it and spreading out a little bit, maybe these value stocks are going to bring some of their own growth to the table. And I think that's what's going on. So the last 4 or 5 years, you just watch Exxon go sideways as everybody thought, the demand for everything they make just kind of came down. Now I think that, with the economy broadening out, that kind of stock can see, a broader demand for its products at higher prices. So they kind of take on a little bit of a growth example. Now, I did mention that there are, some excesses in the market. And the ones I've kind of looked at is, I think the IPO market got slightly bonkers. Whatever your views are on Airbnb and Uber and Lyft and DoorDash and a few others, these are, particularly those last three, are really dependent on, don't make any money, and they're very dependent on the abundance of cheap labor. I mean, you think about DoorDash, that's not exactly a job, a great career for people. Same with Lyft, same with Uber. So they've done well when there's plenty of employment around. Now, if employment gets tighter, I think those companies are going to be toast, just because they'll have to pay much higher rates to keep the thing going. So, but for now, up until very recently, these names came on the market that have been around for 10 years or more. They were the so-called unicorns. They were worth $1 billion and still within the VC hands. And they came to the market and they did very well. The other one is the SPACs, which is the special purpose acquisition companies, which is essentially a blind IPO where you set up a company with cash and it acquires a private company and gets a reverse listing. I've oversimplified, but that's basically what it is. And then the other one is electric vehicles. And this is some of the SPACs and the electric vehicles. And look, this is just January. They had this up there doing well. This is Nikola, which is a car company, electric car company, which I don't think makes cars yet, but it's promised it will do. It's worth $70 billion. Tesla, we know about. Li Auto is a real thing. Forum Merger is a SPAC that backed into some of these electric vehicles. Blink is, just like its name implies, one of these charging companies that has stations dotted around the country or around particular routes to take on. But look, this is the point. How much they've come down, 30–40% corrections. Now, this is normally a kind of a good excess blow off and no one really gets hurt. Banks aren't involved in these. There's not loans at fault. There's just a bunch of people who are buying the stock at overvalued prices and they're going to get crushed. So that's okay. There's nothing wrong with that. That's sort of creative destruction at its best. The only issue you got is that companies like Tesla, remember this company came in at number 4 in the S&P. So it came flying in at $800 billion market cap, and now it's off whatever it is, 30%. That's going to hurt. So that's going to pull back some of the broader ability for the S&P to move ahead. But the three that I mentioned, the IPO, the SPACs broadly, as well as the electric vehicle stuff, these are excesses, Bitcoin probably as well, but they're not big enough, and this is the important point, to sort of damage the rest of the economy. When you see a bank go belly up that's a real problem because of the leverage involved. I mean, the banks were leveraged 50 to 1. These guys are not really leveraged. There'll be some equity shareholders who get wiped out, but bondholders and creditors won't get wiped out. And also these companies don't come to the government for financial aid. So you get a problem if there's a problem in the financial markets, financial industries, those insurance companies, banks, obviously most important. But it's not really an issue when you get a crash in a sector like this. It's just go sit by the sidelines and watch it play out. It's still a thing. I saw GameStop was up, I don't know, 1,000,000% overnight. Who cares? I mean, it's some people playing on the side. As long as you stay out of it and don't get caught in the whirlwind, it shouldn't have a bigger problem with the market. And I'm very well aware of who's investing in those things and under what kind of margin debt. So I'd say expect markets to track sideways, primarily because it comes such a long way. We've got the stimulus now. We want to see how that pairs out and who it goes to, and how it plays out in the real economy. We've got to monitor the opening rate, and so we've already got some indications here in California. We've got some restrictions which are lifting. You know what to look for. The schools being a big one, the service sectors, and the kind of general progression back to a broader opening economy. The vaccine rate and how quickly we can get people inoculated and moving freely. The stimulus, as I said, is sort of, okay, that's there now. We've got to see how that plays out over the next month or two. I think it's the outlook for that is I'm very optimistic for that. And then we've got to keep signs of the inflation. Yes, it's possible. The sell-off of the bond market and the Treasury inflation protected market is somewhat a recognition that inflation will get higher, but inflation was very low and the Fed wants to see it higher. And I think there's a world away between moving from 1.5% inflation to 2.2 and maybe even 2.5 for a few months versus, some rather reckless talk about runaway inflation and very irresponsible talk about hyperinflation, which, outside of about 5 examples in the last 100 years is not a thing. So I think we will see some uptick there. Some interest rate sensitive market assets will react to that, on the positive side. Inflation goes up, usually quite good for banks in the short term. Because the interest rates go up, but it won't be necessarily good for treasuries. And we've lightened up on those. The consumer arrival will be very strong. See it play out, I think, in nearly all sectors. And the corporate sector remains very upbeat. I mean, we monitored the fourth quarter earnings calls a lot. And generally, companies are in pretty good shape. I mean, there are some which are going to come from a long way back. A Carnival Cruise Line has gone from a dead stop and it's got to start filling up boats and moving those again. But a lot of companies outside of those types of sectors have cut some costs. They've kind of prepared themselves, I think, very well for an uptick, and we've seen this in sort of mid-cap stocks, manufacturing stocks, which have posted quite good outlooks, and some of them are trading at record highs. They're not record earnings yet, but they're certainly the outlook that they see is pretty good, and I think the margin should remain strong. So that's what I've got. It's as I said, I think generally a correction in the market is a healthy thing. I think the inflation debate is also a healthy thing. I come out more on the side that we will see a little bit of uptick in inflation without a fear of it impairing risk assets. But we'll have to watch that carefully over the next few months. So with that, I just want to check if there's any questions. Here we go. Bitcoin is trading at $53,000. Thoughts? I really don't. I would be. I don't. I don't really follow Bitcoin. I mean, I know what it is, but obviously, it doesn't have any intrinsic value. It's like gold. I mean, it sits there on a ledger with a view that if there's a crash in real money, the money supply goes crazy, or the authorities devalue, that somehow Bitcoin will hold its value, and it obviously has some transactional value as well. So I think that anyone that thinks that companies are going to buy it, I mean, I know Tesla did, but that, you've got to factor in the Elon factor for that. If you're a CFO and you bought Bitcoin, you have a real problem because you wouldn't know how to ask. It's an intangible asset, so you have to market to market all the time, which means that your balance sheet's going to go bonkers. So I just don't know. I wouldn't buy it. I mean, I hear these stories about how power hungry the computers are to do the mining. It could be a thing I can see it for transactional purposes, but I wouldn't know how to put a value on something which is essentially pumped up. Non-fungible tokens. I put that into the same category, and I'd say I don't know an awful lot about those. Maybe I should. I'll try and get educated on those for next time. But I think all of these things which are, ledger based and are still more in the realm of it could be something rather than something, the start of something which I see as having a lot of value. Nice question from a good friend. What categories within consumer sector look bullish in Q2? Gosh, I mean, I would say that it's unlikely that companies like Amazon and Tesla, who are the monsters in that sector, will see a big uprush. I mean, I would put my bets on the stocks have rallied, but the hotel, Disney's, movie theaters, that kind of thing. Movie theaters, maybe not so much with the streaming competition, but yeah, I think those will come back quite strongly. I mean, the market's expecting that, but as I know, hotels have very high operational leverage. So 75% capacity versus 85% capacity, it changes the bottom line by a multiple factor, much bigger than that, just the top line. Same with airlines. So I would still say that those are sectors which I would still look at, because I mean, hotels have typically been a cyclical stock, and I think they're going to come back, very, very sharp indeed. Are there ETFs that trade in travel and leisure? Yeah, there are. I can't think of a ticker offhand, but remind me to either give you a call or send you an email. I know who this is, so I'll put one in and I'll give some thoughts to that. And then when the T-bill rate goes up sharply like it did, what does that do for the total retirement price yield of the existing bonds we hold? And how is it different from commercial bonds versus treasury bonds? Basically, was this good or bad for our bond holdings? Okay, T-bills is just the short-term rate. So T-bills is 0 out to a year, and then their notes, and then their notes all the way out to 10 years, and then their bonds. So the recent uptick there wasn't really an uptick in T-bill rates recently. I mean, the 2-year, as I mentioned, was about 11 basis points. But so that doesn't really affect, but on the 10-year bond, I'll answer it as if you were asking around a 10-year bond, which is, what does that do to the total return? Well, a 10-year bond started out the year with a duration of 8 or 9. And the yield went from 1 to 150. So all things being equal, that will mean that the price of a 10-year treasury falls by 4%, and you picked up half a year, a quarter's year of income of 1%. So you were down 3.75%. In a 10-year treasury, we weren't that long. So it would be less than that. Generally, for corporate bonds, it depends not just on the rate, but how the spread is. So was it good or bad for our bond holdings over the last couple of months? In some areas, like the treasuries and some of the corporates, it was, I wouldn't say bad, but it was kind of sideways after a cracking good 20 20. But then other bonds like the commercial mortgage-backed securities that we hold through the River North Fund and the closed-end funds, it's been no difference. We're still running at about 4 or 5% yield on those, and the same for the real estate, which we use as a fixed income substitute. So story's a bit mixed there, but the basic story is if you're holding just treasuries at the long end, hasn't been too good. But if you had a more diverse bond market, CMBS, closed-end funds, as well as mortgage-backed securities, it was generally flat. Someone just giving me their opinion on some very good market timing, which is great. So thank you very much for those questions. Oh, here's one. Any thoughts on real estate, such as offices with the work from home potential to continue even after more reopenings? We like real estate, but not just because of the office side. For those of you that followed us in real estate, we like other sectors like, server, storage, senior housing, government buildings, student housing, a few others that might not seem specialized, retail like labs and pharma work, things like that. But my own feeling is that prime office real estate will bounce back pretty quickly. I mean, I've kept up with New York. I don't know about San Francisco in the bigger scheme of things. It's not as important as places like New York, but there people are coming back. And I think, the head of Goldman Sachs said it right out the other day. He said, work from home isn't working. People are not getting the mentoring. People are not getting the training. People are not picking up the nuances of the offices. They're not figuring out how to, work and operate together. This work from home isn't going to be the new normal. So now in some industries, it might be. And I think what it offers is a lot more people flexibility, to say, well, I'd like to do it 2 days a week or 3 days a week or something like that. And that's all fine. But I think countering that, you think, oh, well, then that means generally less real estate. But the guys that we've talked to remind me that say, well, think about an average, office and how cramped people were together. And if you joined a bank, as I did in the early 80s, and how much space you had, and then you went into a moderately concentrated, high density bank in the last 10 years, people were just crammed together. So I think that the people are going to spread out more. It's what we're doing in our own office. It's like before we had 20 people in this size space. Now there are going to be 20 people in this size space. So don't need to take more space, but people will be more spread apart. And I think that's what's going to happen. So I'm not really I'm not bearish on the real estate side at all. Yeah, there'll be more of some home potential, but then people are going to want to see safety standards and space standards and the ability to move around and walk around in their offices, and that will probably keep the real estate demand quite high. Also, real estate supply. I mean, I know Salesforce said they're going to move out, but I'll believe that when I see it. I still think San Francisco real estate is going to be in pretty high demand, mainly because they don't build enough of it. So, yeah, we're generally kind of like that real estate space. I think some of the doom and gloom was overstated about a year ago. Well, thanks very much, everybody. I have to read the disclosure, but otherwise, if you don't want to stay on for that, and I perfectly understand if you don't, I'll catch you next time. And please send us any questions if you think of something that we didn't cover today. Okay, here's a disclosure. Discussions, the investment strategy, research, investment process of Brian Janikowski are the data indicator as the date of this presentation, subject to change without notice. Charts illustrated throughout this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We cannot assure that the types of investment mentioned in this presentation will produce the intended results or outperform any other investments in the future. We reserve the right to change our investment perspectives and outlook without notice as market conditions dictate and as additional information becomes available. Diversification does not protect an investor from market risk, does not ensure profit, or information is subject to unintentional errors, omissions, and changes without notice. All sources are from facts unless otherwise noticed. While we gather this information from resources we believe to be reliable, we cannot guarantee the accuracy or completeness of any statements or numerical data in this presentation. References to an individual security should be not be construed as a recommendation to buy or sell that security. The securities noted in this presentation are only several of the successful and unsuccessful investments by Brown Janikowski. They don't represent all the securities you have purchased or recommended. The net returns include reinvested dividends and interest, but do not reflect commissions or transaction costs. Mutual fund returns include reinvested dividends and capital gains distributions. Mutual fund returns are net of fund expenses, however, do not reflect Brown Janikowski's fees. Please read the prospectus carefully. Before investing or sending money, past performance no guarantee of future results. We may reference various hypothetical investment illustrations for illustration purposes only, not for investment recommendations, not guarantee indication of future results.